So there's a couple things. First, I think you have to level set on how 2017 was. See, the S&P up about 20%, NASDAQ you just mentioned about 30, IT up about 40, and obviously FANG up about 50%. In that backdrop, you had a great IPO market, right? So when you think about year over year, you had about 37 tech IPOs up from around 23, give or take. And the performance of those IPOs, 75% are up from where they actually priced, and the average return on them is somewhere around 30%. So it's a pretty strong tech market. Now, looking towards 2018, what investors are actually looking for, they're looking to capitalize on a couple of these very big themes, whether it be machine learning, big data, AI, VR, AR, autonomous, a lot of big themes. I think that's what's been driving the FANG stocks so far. They're also looking for more access to growth. So the big tech names grow on average around 10% versus the general market 3-4%. So they want that alpha, they want that growth. You couple that with the backdrop of the number of investable ideas has been shrinking. So in tech, so over the last 5-6 years, you've had the investable company market decline about 20-25%. So there's fewer ideas that give you exposure to these big secular themes.
Because they've been swallowed up by giants, or
because of M&A, because of share buybacks, so you've had just that pool. You've also had the private side, the private capital, sort of push out the IPO market. So now, from the time the average tech company takes its first round of funding, it's about 9 years till they go public. That number used to be around 7, and even younger than that, or smaller than that before that. So you've had this lengthening of the process and large pools of capital that are out there. The interesting thing about that is this large pool of capital is actually investing in fewer ideas, but more capital towards those ideas. So think of, say, the SoftBank fund out there with $100 billion of investable capital.
And certainly we've seen that in other sectors as well, sort of this search for yield right now. I cover insurance, and we've seen that play out there too with cat bonds and other types of things. In terms of the IPO market looking at 2018, what are the expectations in terms of what we could get going public next year? Is it Airbnb? Is it Lyft? Is it other things? And how important, given the valuations we have seen in the tech sector so far, is profitability going to be?
Yeah. So 3 big buckets there in tech, right? So you've got application software, you've got infrastructure, and you've got consumer as well. When you look at all those buckets, there's a good pool, and there's obviously a lot of demand for those companies to go public. Our point of view is that you want to go public for a couple of different reasons. One, that liquidity. Think about how Facebook was able to buy WhatsApp, right? It was because it was a public company able to do that. 2, liquidity for your employees as well. And 3, there's an added layer of discipline that gets brought to a company when you're public. So we think that all sets up well for 2018. To your point on valuations, what I think's changed here that's incremental is that the absolute values, the multiples, have gone up. But when you look at them relative to growth, they've actually stayed about the same. So there hasn't been that much of a multiple inflation when you think of it relative to growth. And with technology, you have to look at it relative to growth.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.